Sunday, got a really highly anticipated guest on this evening, and quite a topical, subject at the moment, which is finance and banks and interest rates. So our topic tonight is how to finance your property like a pro, and we're very lucky to have Mr. Adam Bourke with us tonight. Hey, Adam.
Thanks, Ben.
How are you, mate? So, guys, introducing Adam. Adam Bourke is from Mortgage Choice in Paddington. He's been in broking for 17 years, so quite a while, and gone through a few ups and downs since the year 2000. He's, as mentioned, he's Mortgage Choice Paddington. So I mentioned at the front, at the start of the clip. So he's settled in excess of $1 billion in lending. So this guy knows what he's talking about, ladies and gentlemen. Knows a bit about lending, settling over in excess of $1 billion. He's helped thousands of people, as far as their home ownership dreams and their investment goals. So a very good person to hear from tonight. Some other achievements: his consistency in the Mortgage Professionals Association, the MPA top 50 most years, and probably most impressive when he told me is he's in the Mortgage Choice High Flyers Award. He's won the Mortgage Choice High Flyers Award 12 times. So 12 times he has been the winner. So everything tonight, if any of you guys do have any questions, we do have some questions that got emailed through when we did promote this, and there's some questions that have been asked of me, that have been asked, in previous weeks. So if you do have any questions, please feel free to jump in, and Sam will fire those questions through. So we'll start with some of the ones that we had prepared earlier.
All right, so we've had a question come through from Karen.
Hi Karen, how are you this evening?
How are you seeing the state of lending at the moment, and what sort of deposit are buyers requiring?
For the first time in many years, we're seeing a disparity between investment lending and owner-occupied lending. So the deposit required for a home hasn't changed a great deal. There are still a few lenders who only require 5%, which equates to a 98% loan. So they'll actually, just means they'll have the costs on top. But for investment lending, that's where we've seen the biggest amount of change. So the vast majority of lenders now require not only you to put in a 10% deposit for investment lending, but also to cover all of the purchase costs as well. So your stamp duty, right down to your mortgage insurance. So it's equating to more like an 88% loan, whereas a year ago it would have been more like a 98% loan. So on your average house price of say $500,000-$600,000, there's an extra $50,000 that you've been putting in.
Great. And just to clarify that for the people listening in, Adam, can that be used in equity in a property as well, or are you talking physical cash? They need the cash in the bank.
If it's a first home buyer, then the only way they can use the equity is through a guarantor, and we're seeing more of that. People who have family with equity in property.
Yep.
If you already own a property, then yes, you can use that, but you have to keep your lending ratios across the board at that level. So up to 90% on your existing property.
Yep. And
then if you're investing, you have to keep it at below 90% on the purchased property.
Okay, great. Yeah, no, that answers that. That's a great answer there. So first home buyers, there's a little bit of a lesson to be learned there. Be good to your mother, and make sure that you're kind to your parents, because you might need them as your guarantor. Next one through, Sam.
The next question is from Nicholas.
Hi Nicholas, how are you? I think Nicholas has asked a few questions a bit late.
There's been a lot of talk about investment lending and investors being charged a higher rate. What is an average interest rate for an investor at the moment?
There is no average rate. It's changing on a daily basis. The general trend is that if you are investing, the interest rate is climbing upwards, certainly not down. Investors now, we're seeing, if they're willing to go principal and interest, which is quite rare for an investor. So historically, every investor wants to go interest only.
Yeah, minimise
and even many homeowners for that matter. We're finding that if you were to go principal and interest, some investors could fix at the moment for 3.88 for 2 years.
Yeah.
As opposed to they could go back to their same lender and want to go interest only and be paying 4.92. So
really?
It's more than a 1% variance from interest only to principal and interest. more so than just investment alone.
That's huge, massive difference.
So it started out when ASIC started regulating the industry that it was more if you were investing you were paying a higher rate. It's not just that at the moment, it's investing and interest only. So there are still ways around the higher rates by going P&I, but over time we feel that will eventually level out as well.
Great.
Very cool. So the next question is from Tom.
Hi Tom, how are you?
Where do you see interest rates going in the next 12 months?
Crystal ball.
Crystal ball.
Love hearing this.
Once again, it's going to be a two-tier economy in that the RBA is unlikely to move in the coming 12 months, is most predictions. Some are saying anywhere from no movement to one increase.
Yep.
And then over the next 2 years, maybe as many as 2 rate rises. In saying that, the RBA meeting on the Tuesday of every month is no longer, we're not sitting there with bated breath because rates are moving independent of the RBA now so frequently. In the last month alone, we've seen some of the major lenders go up by 30 basis points for investors or for interest-only lenders. So RBA movements are fairly irrelevant. We think that the interest rate rises for investors and investors have already gone as high as they're going to go outside of the RBA. And we've also seen home loans creep down a little bit. So what lenders are doing is they're offering rates, say, shaving another 6 basis points off their home loan to win business, and they're increasing their rates on the investment. Long-winded answer, but over the next 12 months we feel that investment, certainly interest-only rates, will increase, and home loan rates are unlikely to move up or down.
Further to that, Adam, are you seeing people come to you, because obviously you deal with a lot of different lenders, you're not just CommBank, you're not just Westpac, you're not just Aussie home loans, like you use a different sorts of all different lenders. Are you seeing more than ever in the last 12 months people shop around? Are you noticing that?
Yeah, they have to. It's a year ago, most of the lenders were roughly the same interest rates, had the same fixed rates, similar variable rate discounts. They were pricing heavily for business. Now we're seeing that some lenders are well under their ASIC imposed or ASIC recommended caps on their investment lending, or interest-only lending, and others are almost exceeding it, and in some cases exceeding the ASIC caps. So what we're seeing there is some lenders now are saying to lenders, if you want interest only, we're not offering you any discount on your rate. We don't care if you're borrowing 2 million, 3 million, doesn't matter. And others, for a $150,000 loan, will discount still very heavily for interest only.
Great.
So that disparity is not so much just on the bank's appetite for business, it's based on what's being imposed upon that particular lender by the regulators, which is only going to get worse or change.
Yeah, we're definitely in that sort of change at the moment.
All right, next question is from Nicola.
Hi Nicola, how are you?
Do you recommend principal and interest for your own home or interest only?
Historically, I've always been a big fan of interest only. The regulators are not a fan of interest only, and that's been brought to the forefront in the past 6 months. So historically, we've always said there's been no downside to going interest only as long as you have a good handle on your household budget and you know that you can still save principal in an offset account or pay it directly into the loan. The interest rates have always been the same for the last decade at least. However, now we're recommending principal and interest purely because of the rate difference. So you might go and say, okay, what could I get today for interest only on my home? And we'll say it's 0.5% more than what you'll get principal and interest.
Yeah.
You would be mad to go interest only when the rate difference is so great.
Yeah.
And we're finding even investors are going principal and interest. So in the past 2 months, I would say half of our investors have chosen principal and interest, which is just unheard of historically. And that's all been driven by the regulators trying to bring interest-only lending down under their recommended guidelines. They're afraid of having an entire nation full of people with no equity in their property. And if there is some sort of crash or bubble burst, especially in Sydney or Melbourne, people will have negative equity very quickly.
Yeah.
And that's what they're trying to avoid, and hence the regulation.
Okay, great. So next question is from Tim.
Hi Tim, how are you?
How would you finance a major renovation on your home?
By the way, we are seeing a lot of this. We are seeing a lot of this, guys. Thanks for that question, Tim. We are seeing a lot of this at the moment. I think, I read a report the other day, and I think Adam and I talked about it just before we came on air here, that, that I think renovation and, work being done to property is at 7-year highs. So this is probably a common question. So, if you do have someone that that is doing this at the moment, please feel free to tag them or, share this post with them, because this is pretty important information.
That was Tim, wasn't it?
Tim, yeah.
So it would depend on the size of the renovation is what drives how the finance is set up. If you were doing a new kitchen and bathroom and you were spending $50,000, $60,000 in renovations, as long as you have the equity in your current house, which is purely the loan amount based on the value, most lenders will allow you to just take a cash out portion to fund it. So they'll say, here's the cash, it's in your bank account, we'll increase your loan, and you can use it any way you see fit. Larger than that, we're finding cash out is becoming looked at a lot more closely, and once again driven by the regulators. If you were to come and doing a $200,000-300,000 plus renovation, they will need to control the flow of those funds. So what that means is they'll value the property upon completion, which means they will want to see your plans, your contracts. Doesn't go very well for tradies who are looking to do the work themselves. It can be a little bit difficult to obtain the funding unless they have a separate company.
Company set up, yeah.
But for the majority of borrowers who are using an independent builder, once they provide that, the valuer does the on completion valuation, as it's referred to, and then the bank will slowly pay each progress draw to the builder as it's needed. The more equity you have in a property, the easier that is, because if the valuer says that your $200,000 reno is only adding $150,000 in value, you may not have the equity to actually do the work. But someone who has enough to, it comes down to the valuation in most cases.
Staying on that point, so valuations are very, very, I get calls, probably 3 or 4 times a week what I think a property's worth from a valuer. So basically, you're really in the hands of a valuer when it comes to that, Bourke in that way.
And you can see a difference between two valuers, two different companies.
See it all the time.
Hundreds of thousands of dollars.
Yeah, so that's a very interesting one, because, as you're saying, you're basically in the hands of a valuer, and I guess, with all due respect, they've got to do their job correctly, and they don't know where the market's heading. And as you're sort of insinuating, if you're doing a renovation and you're borrowing $200,000 or $300,000, that renovation or that finished product, they're trying to value a home in a different market. So that's why you find they're probably a little bit more conservative.
Yeah, and it depends on the type of work. If you're adding value in the form of extra bedrooms, something that has a high market appeal can add the sufficient value.
Yeah.
If a lot of it's just purely cosmetic or based on personal preference, or a pool, for example, that may not always add the same amount of value.
Yeah.
The more equity you already have, the better in those instances. The bottom line is the bank wants to control the money, the larger the amount of the cash out.
Yeah.
All right, we've just had a question come through from David Langley.
Hi David, how are you? Hope you're having a good Sunday.
Do the plans need to have development and or building approval to get funding from the bank, or will concept plans suffice?
For the early stages, without having the council approval, for the actual banking approval, that's all that's needed. Before the actual funding and for the bank to start the progress draws to the builders, you do need the full council approval, DA, BAs. To get the valuation, it depends what David means there by concept plan. If it's going to be the final plans, that's all we need for the valuer and the bank to determine will they fund against the project. Because what we find is people will come to us with a plan that may or may not be the finished product and a rough quote from a builder. The valuer then values it, the bank then approves it, and then when it comes to final approval, what we get back is something that's different yet again, which means the whole process has to start from scratch. We had a lady once who was halfway through the build and the progress draw request was different than the originally approved amount. And when I rang her to find out why that was, she had changed it from a 4-bedroom house to a 3-bedroom and opened up a living without telling anybody. So the bank just put a hold on all funds until it could be finished.
All right. Next question is from Gail.
Hi Gail, how are you?
Is now a good time to fix your interest rate as we are seeing at all-time lows?
If the idea of fixing appeals to you and you like the peace of mind of rates not moving, now is probably the best time of all to be fixing, because no one is predicting rates to be going any further south, and surprisingly the fixed rates are pretty much on par with variable, so the banks haven't started increasing their fixed rates at this stage. So if you're leaning towards fixing, yes, I would be doing it now. I wouldn't be rushing out to do it unless you were going to be fixing an investment loan, but fixing a home loan, can't see them dropping any further, no. And not the fixed rates either.
Just on that, and who are you seeing the best to go through at the moment? Who are the fixing fixed rates?
Once again, it depends on what type of lending you're doing. So if you're an investor and you're looking to fix and you're happy to go principal and interest, we're seeing some very sharp rates offered by Westpac and Suncorp. Suncorp is still offering very good interest-only lending, but we feel that will change very soon.
Yeah. Do you get many people that Bourke that do basically the finance, the bridging finance? Do you see much of that these days, or are they crushed down where they haven't?
Sometimes, yeah.
Where say someone's bought their house in Barden, haven't sold the house in Paddington yet.
Yeah.
Got an agreement with the bank that they need to sell it within 6 months. Like I get that a lot, where someone says, look, we've got to put our property on the market. The bank says we've got to sell it for 6 months. Say in that 6 months, are they paying bridging finance, so to speak, or are they just paying a normal rate then bridging finance if they haven't sold after then?
Yeah, bridging finance has a bad name. Historically,
doesn't sound
the
good.
rates could jack up and people were stuck paying 2 mortgages. Bridging finance these days is actually no different than normal finance.
Yeah.
The challenge is having enough equity in your property to do it. So we find a lot of people who maybe only have a few $100,000 in equity in the property and they're upgrading to a more expensive property. The banks want both of them to be at 80%, including capitalised interest on the amount they can't afford. Because essentially what a bridging loan is saying I can't afford both mortgages, so the bank's going to fund the repayments on one until you can sell the property and pay that loan out. So the interest rates are the same. The banks don't jack the rate up. However, if you haven't sold in 12 months, the bridging component, the bank's within their rights to kick in onto a default rate.
Yeah.
However, if you haven't sold your house in 12 months, you're doing something wrong, I think.
Yeah.
Your expectation on the price is not correct.
Yeah. I always say that there's something in this market, there's something wrong with the house, or there's something wrong with the price. So, it's an easy problem to fix.
Yeah, our advice on bridging is always be very conservative on your sale price, and then you'll know that you can fulfil your end of the bridging agreement.
I mean, any other, obviously, there might be some other questions that come through, during the week, but I mean, I guess if we're to take one thing away tonight, what's your best advice, when, going to look for your home loan? So, a young family out there watching at the moment, looking to, get in, to the market, because I think I did mention to you, I'm having a few people that are getting a little bit misguided as far as, maybe speaking to a broker, not Adam Bourke here, and asking for, longer extended periods of, finance and 30 days finance and all these sort of things. I mean, if I'm, out there in the marketplace, you don't want to be caught with your pants around your ankles, so to speak. You want to be, you want to be in a good position. How many days should you allow, or, so what's the process? Should they set up a meeting with someone like yourself or their bank or their broker? Just run us through that little process so they're in a position to be able to go out, bid at auction, put an offer in that's, that's going to be, pretty compelling and likeable, to the owner, because it's not very attractive. The word is attractive to put an offer in that's subject to this and subject to that. So I guess, we've talked about this a number of times over sushi down at Moga and Rosalie, that, the cash conditional contracts or contracts that don't need finance approval are a lot more attractive to the seller when you're looking to buy than having a long extended period, a long settlement. So what's the process?
Without a doubt, PreApprovals.
Yep.
A lot of people come to us thinking that a PreApproval is purely to determine whether or not they can get finance. it's not. It's actually just to save time on applying for finance.
Yep.
So I could sit with you and tell you exactly how much you could borrow, go through all of your financial information. However, until we submit a pre-approval, that can sort out any potential questions that the lender may have. It could be about a HEX debt that wasn't disclosed, someone didn't realise they had to mention it. It could be a number of things. If we get all of those questions out of the way in a pre-approval, that person can then go out looking at property, safe in the knowledge that all they need to provide to the lender is a contract of sale.
And even taking one step back, Bourke, can bid at auction on a pre-approval?
Depends on the lender. So some lenders' pre-approvals aren't worth the paper they're written on.
Really?
It virtually goes to an automated system and the computer says, congratulations Ben, you're pre-approved. And then when you sign a contract and send that back to the lender then it goes to a live human being, credit manager, who may look at the application and say, oh, I don't like these three components. We've heard of people going to auctions and having their pre-approvals declined. So we would always...
That's not a good situation to be in, by the way.
No, we would always choose a lender that gives a solid pre-approval. If the first question I ask is, are you considering going to auction for any properties, or are you going to be signing a 14-day finance clause? If they're going to auction, we would always recommend a lender that's going to give a formal pre-approval, which means a credit manager signs off. It's only subject to the contract of sale on the valuation.
Yeah. And obviously, I get asked all the time, and you get asked all the time. You got people who got companies, trusts, all these running costs. Would you be able to get a pre-approval or know someone's circumstances? I know every circumstance is different, so we're using it broadly here for the majority. How quickly could you be able to get someone's finance approved, saying that they both say, okay, let's say mum and dad both work, 2 kids, both go to school, kids are 5 and 8.
Depends if they're self-employed or not. Do you mean without a pre-approval?
Yes.
From start to finish?
Start to finish. When could they expect? How long could they expect to get their finance sorted so they can go out in the marketplace and start looking to buy property and put a solid offer in without making it subject to the cow jumping over?
The pre-approval, if they haven't signed a contract yet, we have lenders that will approve them within hours. Others within 24 to 48 hours.
Yeah.
Look, even a slow lender usually is 4 to 5 days.
Yeah.
That being said, some of the lenders have groups that they put their brokers under. So if you write a significant volume with that particular lender, you may get a 24-hour turnaround. And if you don't write any loans with that lender, you may get a 24-day turnaround. So there's a very big difference. And we think that, once again, this is another thing that the regulator will take steps to change. We think it's a good thing because we write the good volumes through lenders that we use a lot of. However, they're trying to remove that. It could just mean that everyone's worse off if that changes. In other words, everyone goes from 24 hours to 12 days, somewhere in the middle.
Yeah.
Once again, a long answer for a simple question. Anything under a week for a pre-approval is very realistic. And then once you've signed a contract, 3 to 4 business days, because all they need to do is value the property. And in many cases, lenders don't even value the property if the borrower...
They're not doing that much lately, mate. Like, there's been a couple that we've sold lately, and they haven't, and we've gotten the finance approval through, the buyer's got their finance approval, and I've even asked them and said, their financier or their solicitor, are they doing a valuation? And some are even doing curbside valuations, are they? Or is that right? Or
many are doing no valuations.
No values.
Not even desktops. So if the contract of sale says the sale price is $700,000, and it's a 20% deposit, and it's between a third party real estate, so there's no developer involved, or there's not buying from a
not buying it from your family or anything like that.
Then the bank feels that it's worth what someone's willing to pay on the market, because it's very rare for a valuer to come in and undervalue a purchase property.
Yeah.
It does happen, but it's usually a brand new apartment, for example.
Yeah, brand new apartment, or or could be a valuer that's out of the area.
Yeah, that's right.
Sometimes
the reason they sometimes value the apartments low is because they're comparing them to established apartments in the same area.
So you're valuing a new a second-hand apartment against a new one, or one's coming out of the ground.
Which is not overly fair, but that's the way they do it.
Yeah. Well, thanks, guys. Thanks for tuning in tonight, and thanks very much. And look, I'd really like to thank Adam Bourke. Bourke, thank you.
Thanks, Fabian.
Guys, so look, if you are looking to finance your property, I can't speak highly enough of this gentleman. Look, I've known, Adam for, out of his 16 years, I think I've known him for, working as a mortgage broker, not 16 years. He's a bit older. He's a bit older than that. Unfortunately. The years I've known Adam, he's been great, and there's been a number of referrals both ways, and he's always managed to look after the clients that I refer him. So if you do have any finance questions, please get in contact with him. He does have a long email, so we won't read it out. So he is Adam Bourke from Mortgage Choice Paddington, just down in Rosalie. So thanks very much for tuning in tonight, guys. And if you have any further questions, please don't hesitate to send me a direct message. And if you've got any questions for Adam, I'll pass them on. Have a great night. Thank you.